I need to warn you about something that is going to destroy trillions of dollars in wealth. Something that most investors cannot see because they are blinded by hype and greed. Something that I have seen before, twice before actually. And both times, the people who did not listen lost everything. I am talking about the artificial intelligence bubble. And I am going to tell you exactly which 7 stocks are going to crash 80% or more, just like Cisco did in 2000. I know what you are thinking. Here goes Burry again, always predicting doom, always bearish, always negative. But let me remind you of something. I predicted the housing bubble and made billions when it crashed. I predicted the dot-com bubble before that. I have been right about every major market dislocation in my investing career, not because I am a perma-bear, not because I enjoy being contrarian, but because I actually do the math. I actually look at the fundamentals, and I actually have the courage to say what everyone else is too afraid to say. The artificial intelligence stocks today are in the exact same bubble that technology stocks were in during 1999 and 2000. The exact same pattern, the exact same euphoria, the exact same disconnect between valuations and reality. And it is going to end the exact same way. With a crash that wipes out 80 to 90% of the value in these stocks, with retail investors left holding worthless shares, with a generation of wealth destroyed. I am going to walk you through the parallels between then and now. I am going to show you the specific financial metrics that prove these stocks are wildly overvalued. I am going to identify the 7 stocks that are most at risk. And I am going to explain exactly why they are going to crash. Because I want you to be prepared. I want you to get out before the collapse. I want you to learn from history instead of being doomed to repeat it. But first, let me tell you about what happened to Cisco. Because this is the perfect case study. The perfect parallel to what is happening today with AI stocks. And if you understand what happened to Cisco, you will understand what is about to happen to these 7 companies. In March of 2000, at the peak of the dot-com bubble, Cisco was the most valuable company in the world. The stock was trading at $82 per share. The market capitalization was over $550 billion. $550 billion. For a company that made networking equipment, routers and switches, hardware that connected computers and enabled the internet. Now, Cisco was not a bad company. It was actually a very good company. It had real products, real customers, real revenue, real profits. Unlike many of the dot-com companies that had nothing but an idea and a website, Cisco was a legitimate business. It was growing fast. Revenue was increasing at 20 to 30% per year. Earnings were growing at 30 to 40% per year. The fundamentals were strong, but the valuation was insane. At $82 per share, Cisco was trading at over 200 times earnings. 200 times. The stock price reflected expectations that Cisco would continue growing at 30 to 40% per year for decades. That it would completely dominate networking forever. That nothing could go wrong. That the internet boom would never end. Of course, it did end. The dot-com bubble popped in March of 2000, and what happened to Cisco? The stock fell from $82 to $8 over the next 2 years. It lost 90% of its value. $500 billion in market capitalization evaporated. Investors who bought at the peak lost almost everything. And here is the thing. Cisco did not fail as a business. Revenue kept growing, profits kept growing, the company continued to dominate the networking equipment market. It is still a major player today. The business fundamentals were fine. What collapsed was the insane valuation. The stock went from 200 times earnings to 15 times earnings. That is what caused the 80% crash, not business failure. Valuation normalization? This is critical to understand. When a stock is trading at a reasonable valuation and the business deteriorates, the stock can fall 50% or maybe 70%. But when a stock is trading at an insane valuation based on unrealistic expectations, and those expectations moderate even slightly, the stock can fall 80 or 90% even if the business is doing well. That is what happened to Cisco, and that is what is going to happen to these AI stocks. Let me walk through the parallels between the dot-com bubble and the AI bubble, because they are striking, almost identical in every important way. First, there is the revolutionary technology narrative. In the late 1990s, the story was that the internet was going to change everything. Every business would move online. E-commerce would replace traditional retail. Internet advertising would replace traditional media. The internet was going to create a new economy where old rules did not apply. Does this sound familiar? Today, the story is that artificial intelligence is going to change everything. Every business will be transformed by AI. Productivity will explode. Entire industries will be disrupted. AI is going to create a new economy where old rules do not apply. It is the exact same narrative. Different technology. Same hype. Second, there is the land grab mentality. In the late 1990s, companies were spending billions to build out internet infrastructure. Telecom companies were laying fiber optic cable. Data centers were being built. Networking equipment was being purchased at unprecedented rates. Companies were terrified of being left behind. They were spending money they did not have on technology they did not need because they were afraid their competitors would get ahead of them. Today, companies are spending hundreds of billions on AI infrastructure. NVIDIA GPUs, data centers for AI training, cloud computing capacity, software and services. Companies are terrified of being left behind in AI. They are spending money they do not have on technology they do not fully understand because they are afraid their competitors will get ahead of them. Same pattern, same fear-driven spending. Third, there is the gold rush for investors. In the late 1990s, everyone wanted to own internet stocks. It did not matter if the companies were profitable. It did not matter if they had sustainable business models. If it had .com in the name, investors bought it. Stock prices went parabolic. Valuations reached levels never seen before. Rational analysis was thrown out the window. Today, everyone wants to own AI stocks. It did not matter if the companies have proven AI business models. It does not matter if they can sustain the current growth rates. If it has AI in the description, investors buy it. Stock prices have gone parabolic. Valuations have reached levels rarely seen outside of bubbles. Rational analysis has been thrown out the window. Fourth, there is the "this time is different" mentality. In the late 1990s, when people pointed out that internet stocks were overvalued, the response was always, "You don't understand. This is different. The internet changes everything. Old valuation metrics don't apply. You're using outdated thinking. This is the new economy." Today, when people point out that AI stocks are overvalued, the response is always, "You do not understand. This is different. AI changes everything. Old valuation metrics do not apply. You are using outdated thinking. This is the new AI economy." It is word for word the same argument, and it is word for word as wrong today as it was in 2000. Fifth, there is the exponential growth assumption. In the late 1990s, investors assumed that internet companies would grow exponentially forever, that the total addressable market was infinite, that there were no constraints on growth, that margins would stay high forever. These assumptions were baked into stock prices at 200 times earnings or more. Today, investors are assuming that AI companies will grow exponentially forever, that the total addressable market is infinite, that there are no constraints on growth, that margins will stay high forever. These assumptions are baked into stock prices at 100 times earnings or more. Same flawed math, same unrealistic expectations. Now, let me be very clear about something. I am not saying artificial intelligence is not real. I am not saying AI is not important. I am not saying AI will not transform industries and create enormous value. AI is real. It is important. It will be transformative. Just like the internet was real and important and transformative, but here is what people forget about the internet. Yes, it changed everything. Yes, it created enormous value. But that value accrued over decades, not years. And it accrued to different companies than investors expected. Most of the dot-com companies that had huge valuations in 2000 failed. They went bankrupt. They disappeared. The value eventually accrued to companies like Google and Amazon and Facebook that either did not exist yet or were not the hot stocks during the bubble. The same thing is going to happen with AI. Yes, AI will create enormous value over decades, but most of that value will accrue to companies and business models that we cannot predict today. And most of the companies that have huge AI valuations today are going to disappoint. Their growth will slow, their margins will compress, their competitive advantages will erode, and their stock prices will crash. Let me now identify the 7 stocks that I believe are most at risk. The 7 stocks that are trading at Cisco in 2000 valuations. The 7 stocks that are going to crash 80% or more when this bubble pops. The first stock is a company I will call the AI chip maker. You know which one I'm talking about. The company that makes the GPUs that are essential for training AI models. This stock has gone from $150 per share in early 2022 to over $1,000 today. The market cap has gone from $400 billion to over $3 trillion. Now, this is an excellent company. They make great products. They have a near monopoly on AI training chips. Their revenue and earnings are growing at incredible rates. I am not disputing any of that. What I am disputing is the valuation. At current prices, this stock is trading at over 50 times earnings. For a hardware company, a semiconductor company. That is insane. Semiconductor companies historically trade at 15 to 20 times earnings, even the best ones, even during boom times. Why? Because the semiconductor business is cyclical, because competition always emerges, because customers always find alternatives, because margins always compress over time. This is the history of the semiconductor industry going back 70 years. But investors today are assuming that this company is different, that their dominance will last forever, that competition will never emerge, that margins will stay at 70% forever, that customers will never find alternatives. These assumptions are built into a 50 times earnings multiple, and these assumptions are wrong. Competition is already emerging. Other chip companies are developing AI accelerators. Hyperscalers are designing their own custom chips. Software improvements are reducing the need for cutting-edge hardware. The competitive moat is narrower than investors think. And when competition intensifies and margins start to compress and growth slows, this stock is going to get re-rated from 50 times earnings to 20 times earnings. That alone is a 60% decline. And if we hit a recession or a semiconductor downturn, it could easily be 80%. This is Cisco in 2000. A great company with a dominant market position trading at an insane valuation that assumes perfection forever. It is not going to end well. The second stock is a hyperscaler that has positioned itself as the AI cloud leader. This company has seen its stock go from $250 to over $500 over the past 2 years, as investors have gotten excited about its AI capabilities. The market cap is now approaching $3 trillion. Again, this is an excellent company, dominant cloud platform, strong AI offerings, growing fast. But the valuation is stretched beyond reason. The stock is trading at 35 times earnings. For a mature cloud company with decelerating growth, that makes no sense. Cloud computing is becoming a commodity. Margins are compressing as competition intensifies. The 3 major hyperscalers are all competing aggressively on price. Customers are getting smarter about multi-cloud strategies and are negotiating better terms. The days of 50% operating margins in cloud are ending, and the AI story is overblown. Yes, this company is offering AI services, but so are the other hyperscalers. There is no sustainable competitive advantage in AI cloud services. The models are largely the same. The infrastructure is largely the same. It is becoming a commodity. And commodities do not trade at 35 times earnings. When investors realize that AI cloud is not a winner-take-all market, when they see margins compressing, when they see growth decelerating, this stock is going to re-rate. From 35 times earnings to 20 times earnings, that is a 43% decline. And again, in a broader market downturn, it could be much worse. The third stock is a software company that has pivoted to AI. This company makes productivity software that has been around for decades. Mature business, slow growth, but they have rebranded themselves as an AI company. They have added AI features to their products. They have launched an AI assistant, and investors have gone crazy for it. The stock has doubled in 2 years. The market cap is over $3 trillion. The stock is trading at 38 times earnings. For a company that was growing at 5% per year before AI and is now growing at 12%, the market is valuing them as if the AI pivot has transformed them into a hypergrowth company. It has not. Most of the AI features are incremental improvements. Nice to have, but not revolutionary. Customers are not paying significantly more for them. The impact on margins is minimal. This is not a transformation. This is a mature software company, adding some new features and slapping an AI label on it to juice the stock price. When investors realize that the AI features are not driving meaningfully better financial results, when they see that growth is still mediocre, when they see that this is not actually an AI transformation story, the stock will re-rate. From 38 times earnings back to 25 times earnings where mature software companies trade, that is a 34% decline. And if the overall market sells off, worse. The fourth stock is an AI software pure play. This company builds AI applications for enterprises. They went public in the past few years at a huge valuation based on the AI hype. The stock is trading at 15 times revenue. 15 times revenue. For a company that is losing money. For a company that has never made a profit. For a company that has negative free cash flow. Revenue multiple-based valuations only make sense for companies that have a clear path to profitability and where the eventual profit margins are known. For this company, neither is true. They are spending enormous amounts on sales and marketing to acquire customers. Their customer acquisition costs are higher than their lifetime value. They are burning cash, and there is no line of sight to profitability. Investors are valuing them at 15 times revenue because they are assuming that eventually, maybe in 5 or 10 years, this company will have 30% operating margins and will be worth 50 times earnings. So working backwards, 15 times revenue at 30% margins equals a 50 times earnings multiple. That is the math. But this math is insane. First, this company might never get to 30% operating margins. Software companies that sell to enterprises typically have 20 to 25% operating margins, not 30. Second, it is going to take many years to get there, if they ever do. Third, there is no guarantee they will not run out of cash before they become profitable. When investors realize that this company is just burning cash with no clear path to profitability, when they see that the competitive landscape is getting more crowded, when they see that customer acquisition costs are not coming down, the stock is going to crash. From 15 times revenue to maybe 5 times revenue, if they are lucky. That is a 67% decline. And if they do not get to profitability and need to raise dilutive capital, it will be much worse. The fifth stock is another AI chip designer. Not the market leader, but a company that has benefited enormously from the AI boom as investors have looked for alternative ways to play the theme. This stock has gone from $50 to $250 in 2 years, a 5 times increase. The problem is that this company does not actually have AI chips that are competitive with the market leader. They have chips that can be used for some AI workloads, but they are inferior. They have lower performance, higher power consumption, less software support. No one is choosing these chips over the market leader's chips unless they cannot get access to the market leader's chips due to supply constraints. Right now, there are supply constraints, so this company is benefiting. They are selling chips at high prices because customers cannot get enough of the market leader's products. But supply constraints are temporary. Capacity is being added, and when supply catches up with demand, customers will shift back to the superior products. This company's sales will collapse. The stock is trading at 40 times earnings based on current inflated sales and margins. When sales decline and margins compress as they lose pricing power, earnings will fall by 50% or more, and the multiple will compress from 40 times to 20 times. That is an 80% decline from peak, maybe more. The sixth stock is a data center REIT, real estate investment trust that owns data centers. These have been bid up enormously because everyone knows that AI requires massive amounts of data center capacity. So investors have been buying anything related to data centers, including the real estate. This REIT has gone from $80 per share to $180 per share. The yield has compressed from 6% to under 3%. The stock is trading at 30 times funds from operations for a REIT. That is bubble territory. Data centers are real estate. Real estate is a capital-intensive, low-margin business. Data center REITs historically trade at 15 to 20 times FFO with yields of 4 to 6%. But investors today are treating them like growth stocks. They are ignoring the fact that building data centers requires enormous capital expenditures, that competition is intensifying, that customers are powerful and negotiate hard on pricing. When the AI CapEx boom slows down, and it will, demand for new data center capacity will decline. Occupancy rates will fall. Rental rates will come under pressure. This REIT will have to cut its dividend to fund capital expenditures. and the stock will get re-rated from 30 times FFO back to 15 times FFO. That is a 50% decline, plus whatever happens to the overall REIT market in a downturn. The seventh stock is an enterprise software company that has added AI features to its platform. This company sells customer relationship management and other enterprise software. Mature business, modest growth, but they have launched AI-powered tools, and investors have gotten excited. The stock has gone from $150 to over $300. The stock is trading at 50 times earnings. 50 times. For a company growing at 15% per year. That is a PEG ratio over 3. Way too high. This valuation only makes sense if you believe that the AI features are going to dramatically accelerate growth. But there is no evidence of that yet. Early signs suggest that customers are interested in the AI features but are not willing to pay significantly more for them. The company is having to bundle them into existing subscriptions or offer them at low incremental cost to drive adoption. The impact on revenue and margins is minimal so far. When it becomes clear that the AI features are not driving a meaningful acceleration in growth or margins, this stock will get re-rated from 50 times earnings to 30 times earnings, which is where enterprise software companies with 15% growth typically trade. That is a 40% decline. And in a market downturn, much worse. Those are the 7 stocks. 7 companies trading at valuations that only make sense if everything goes perfectly for the next decade. 7 companies where the current stock prices have already priced in years and years of flawless execution. 7 companies where there is no margin for error. 7 companies that are going to crash when reality does not live up to the hype. Now, let me walk through the specific catalysts that are going to cause these stocks to crash. Because bubbles do not pop randomly. There are specific triggers, specific events that cause investors to reassess. Specific moments when the music stops and everyone realizes there are not enough chairs. The first catalyst will be a major AI model failure or embarrassment. One of the large language models will do something egregiously wrong, make a huge error, provide dangerous advice, show serious bias, create content that causes legal or reputational damage. And this will cause enterprise customers to slow their AI deployments while they reassess the risks. This will hit revenues at the AI software companies. It will reduce demand for AI infrastructure. It will cause investors to question the timeline for AI adoption. Stock prices will fall, and the bubble narrative will start to crack. The second catalyst will be margin compression at the AI chip leader. As competition emerges, as customers develop alternatives, as hyperscalers negotiate harder, the 70% gross margins that this company currently enjoys will start to compress. They will still be profitable. They will still be a good business. But margins will drop to 60%, then 50%. And investors who assumed margins would stay at 70% forever will panic and sell. This will have a ripple effect across all AI stocks. If the company with the best competitive position is seeing margin pressure, what does that mean for everyone else? Investors will reassess valuations across the board. Multiples will compress. Stocks will fall. The third catalyst will be the first major write-down or impairment charge related to AI investments. Some company will have spent billions on AI infrastructure, AI software, AI initiatives, and they will announce that the expected returns are not materializing, that they are taking a multi-billion-dollar charge, that they are scaling back their AI plans. This will cause other companies to reassess their own AI spending. CFOs will start asking harder questions about ROI. AI capex will slow. And the growth projections that are baked into AI stock valuations will start to look unrealistic. The fourth catalyst will be a broader economic slowdown or recession. When the economy slows, companies cut spending. Technology spending is always one of the first things to get cut. AI spending will be no exception. In fact, because AI spending is discretionary and not yet mission critical for most companies, it will probably get cut even more aggressively than other technology spending. When AI spending slows, revenues will miss expectations, growth rates will decelerate, and stocks that are priced for perfection will crash. The fifth catalyst will be a major product announcement from a traditional technology company that commoditizes AI, maybe an open source model that matches the performance of the leading commercial models, maybe a breakthrough in AI efficiency that dramatically reduces the need for expensive infrastructure, maybe a major cloud provider offering AI services at much lower prices. Whatever the specific event, it will make investors realize that AI is not going to be a winner-take-all market, that margins will compress, that competition will intensify, and that the companies with huge AI valuations are not as uniquely positioned as investors thought. One or more of these catalysts will hit over the next 12 to 24 months. And when they do, the AI bubble will pop. Just like the dot-com bubble popped in March of 2000. Suddenly, violently, brutally. Now let me address the objections I always hear when I make these kinds of warnings. First, people say, but the companies are actually making money. Unlike the dot-com companies, these AI companies have real revenue and real profits. True. But so did Cisco, and Cisco still fell 90%. The issue is not whether the companies are real businesses. The issue is whether the valuations are sustainable, and they are not. Second, people say, AI is different. It is more transformative than the internet. Maybe, maybe not. But even if it is, that does not justify the current valuations. The internet was incredibly transformative, but that did not prevent a 90% crash in internet stock prices. The transformation happens over decades. The stock prices reflect expectations of transformation happening in the next few years. Those expectations are wrong. Third, people say you are always bearish. You always predict crashes. This is not true. I am only bearish when I see specific, identifiable bubbles based on quantitative analysis. I was bearish on subprime mortgages in 2006 and 2007 because the math did not work. I was right. I was bearish on internet stocks in 1999 because the valuations were insane. I was right. I am bearish on AI stocks today for the same reasons. The math does not work. The valuations are insane. Fourth, people say everyone knows it is a bubble, so it cannot be a bubble. This is flawed logic. Yes, people are talking about whether AI stocks are in a bubble, but they are still buying. The inflows into AI-focused funds and AI stocks are still enormous. Retail investors are still piling in. Institutional investors are still underweight and feeling pressure to chase performance. Just because people are aware of the possibility of a bubble does not mean they are acting on that awareness. Fifth, people say the Federal Reserve will step in. They will cut rates. They will support the market. Maybe. But the Fed cannot prevent a bubble from popping. They can try to cushion the blow afterward. But once a bubble reaches a certain point, once valuations become untethered from fundamentals, a correction is inevitable. The Fed cannot repeal the laws of financial gravity. Let me now walk through what I am doing with my own portfolio in response to this bubble. Because it is not enough to identify a bubble. You have to position yourself to either profit from it or at least protect yourself. First, I have zero exposure to the 7 stocks I identified. Zero. I do not own them. I will not own them. No matter how much they go up in the short term, I will not chase. I learned this lesson in the late 1990s. I was short internet stocks in 1998 and 1999. I was early. The stocks kept going up. I lost money on the shorts for over a year, but I held my conviction. And when the bubble popped in 2000, I made all of it back and more. I am in the same position today. I am short some of these AI stocks. I am losing money on those shorts right now as the stocks keep going up, but I am holding my conviction because I know that when the bubble pops, and it will pop, these shorts will be enormously profitable. Second, I am long companies that will benefit from AI, but are not priced as AI stocks. Companies in industries like healthcare, education, professional services that will see productivity improvements from AI, but are trading at normal valuations. These companies will capture real economic value from AI without the valuation risk. Third, I am holding more cash than normal. When the AI bubble pops, it will create opportunities to buy great companies at depressed prices. I want to have dry powder ready. I do not want to be fully invested and forced to sell good holdings to raise cash at exactly the wrong time. Fourth, I am short the broader market indices through put options. When the AI stocks crash, they will take the indices down with them. The Nasdaq is heavily weighted toward these AI stocks. The S&P 500 is increasingly concentrated in mega-cap technology, including AI. When those stocks fall 80%, the indices will fall 30 to 50%. I want to profit from that. Fifth, I am long volatility. Volatility is very low right now. The VIX is in the low teens. Investors are complacent. They do not see risk. When the AI bubble pops, volatility will spike. The VIX will go to 40 or 50 or higher. Long volatility positions will pay off enormously. This is not a complex strategy. This is not sophisticated. This is simple risk management based on recognizing that valuations are extreme and a correction is coming. This is what anyone with common sense should be doing right now. But most investors are not doing it. They are caught up in the hype. They are chasing returns. They are going to get destroyed. Let me close with this. I understand that my warnings are not popular. I understand that most people do not want to hear that the stocks they own are going to crash. I understand that it is more fun to believe in the AI revolution and ride the momentum higher, but I am not here to tell you what you want to hear. I am here to tell you the truth based on rigorous analysis. The AI bubble is real. The valuations are unsustainable. These 7 stocks are going to crash 80% or more, just like Cisco did in 2000. You have been warned. What you do with that warning is up to you. You can ignore it, like most people will. You can dismiss me as a perma-bear, like most people will. Or you can look at the data, do the math, study history, and protect yourself. I know which choice I have made. I hope you make the right choice too. Let me now go much deeper into the historical parallels, because understanding exactly what happened in 2000 is critical to understanding what is about to happen now. The details matter. The sequence of events matters. And the more you study that period, the more you will see that we are following the exact same script today. In 1998 and 1999, there was a specific escalation pattern in the technology bubble. First, the professional investors got excited. The hedge funds and mutual funds started accumulating technology stocks. They had rational-sounding arguments. The internet is revolutionary. These companies are growing at 50 to 100% per year. Traditional valuation metrics do not apply to transformational technologies. Then the financial media amplified the story. CNBC became essentially a 24-hour infomercial for internet stocks. Magazine covers featured young .com CEOs. Business books about the new economy became bestsellers. The message was everywhere. If you are not invested in technology, you are missing out. You are going to be left behind. Then retail investors piled in. Your neighbor was making money in internet stocks. Your coworker was making money. Your brother-in-law was making money. Everyone at cocktail parties was talking about their stock gains. The fear of missing out became overwhelming. People who had never invested in stocks before were opening brokerage accounts and buying anything with .com in the name. Then the really crazy stuff started. Companies would add .com to their name and the stock would double. Companies with no revenue would go public at multi-billion-dollar valuations. Day trading became a phenomenon. People were quitting their jobs to trade stocks full-time. Stock split announcements would cause stocks to jump 20%. The disconnection from reality became total. We are at that exact same stage right now with AI. Professional investors got excited about AI first. Then the financial media amplified it. Now retail is piling in, and we are starting to see the really crazy stuff. Companies adding AI to their descriptions and seeing stock prices jump. AI startups raising money at absurd valuations. People quitting their jobs to start AI companies. The pattern is identical. And here is what happened next in 2000. The Nasdaq peaked on March 10th. It then fell 50% over the next year, 78% over the next 2.5 years. $5 trillion in market value evaporated. But it did not happen all at once. There were brutal rallies within the decline. Bear market rallies that convinced people the bottom was in, that the worst was over, and then the selling would resume and stocks would make new lows. The people who got hurt the worst were the ones who bought those rallies, who tried to catch the falling knife, who kept thinking it had to be the bottom. They averaged down, they kept buying, and they lost everything. Because when a bubble pops, stocks do not go down 10 or 20% and then recover. They go down 80 or 90%, and they stay down for years, sometimes decades. Cisco peaked at $82 in March of 2000. It fell to $8 by October of 2002. It did not get back to $82 until never. It is still not back to its 2000 peak 25 years later. Think about that. 25 years. A quarter century. Still underwater. That is what happens when you buy at the peak of a bubble. This is what is going to happen to these AI stocks. They are going to fall 80% or more. And they are not going to recover for decades, if ever. Because the valuations are so extreme that even if the businesses do well, even if AI is as transformational as everyone thinks, the stocks cannot grow into these valuations. The math does not work. Let me give you the specific math on each of the 7 stocks to show you exactly how overvalued they are and how far they can fall. The AI chip leader, trading at 50 times earnings. Let us say earnings are $100 billion this year. That is a $5 trillion market cap. Now let us project forward. Best case scenario, earnings grow at 30% per year for 5 years. That gets you to $371 billion in earnings. If the stock trades at 20 times earnings at that point, which is generous for a mature semiconductor company, that is a $7.4 trillion market cap, from $5 trillion to $7.4 trillion. That is a 48% gain over 5 years, about 8% per year, but that is the best case. What if competition emerges and margins compress? What if growth slows to 20% per year instead of 30? What if we hit a semiconductor downturn? Then earnings might only be $250 billion in 5 years. At 20 times earnings, that is a $5 trillion market cap. Zero gain. You would have been better off in treasury bills. And what if the stock gets re-rated to 15 times earnings, which is where semiconductor stocks have historically traded? Then it is a $3.8 trillion market cap, a 24% decline from here. And if earnings disappoint and only grow at 15% per year and the multiple contracts to 15 times, you get a $2.2 trillion market cap, a 56% decline. You see the asymmetry? Best case, you make 8% per year. Downside cases, you lose 24 to 56% or more. That is not a good risk reward. That is a terrible risk reward. And yet people keep buying because the stock keeps going up and they do not want to miss out. The hyperscaler AI cloud leader, trading at 35 times earnings on, let us say, $75 billion in earnings. That is a $2.6 trillion market cap. Project forward 5 years. Best case, earnings grow at 15% per year. That gets you to $151 billion in earnings. At 25 times earnings, that is a $3.8 trillion market cap, about 46% gain over 5 years, less than 8% per year. But if growth slows to 10% and the multiple compresses to 20 times, which is reasonable for a mature cloud company, you get a $1.9 trillion market cap, a 27% decline from here. And if margins compress due to competition and growth slows and the multiple goes to 18 times, you could see a 50% decline or more. Again, asymmetric to the downside, small upside, large downside, bad risk reward. The mature software company with AI features, trading at 38 times earnings on, let us say, $80 billion in earnings, $3 trillion market cap. Project forward 5 years with 12% earnings growth, you get $141 billion in earnings. At 25 times earnings, that is $3.5 trillion. 17% gain over 5 years, about 3% per year. But if the AI boost fades and growth reverts to 5% and the multiple goes back to 20 times where this stock traded before AI hype, you get a $2 trillion market cap, a 33% decline. And in a market downturn with multiple compression to 15 times, you could see a 50% decline. You start to see the pattern. These stocks all have the same problem. Massive valuations based on aggressive growth assumptions and high multiples. Small upside if everything goes perfectly. Large downside if anything goes wrong. Terrible risk reward across the board. Now let me talk about the psychology of bubble participants. Because understanding the psychology is critical to understanding why people keep buying even when the math clearly shows the stocks are overvalued. There is recency bias. The stocks have been going up for 2 years. Every time someone said they were overvalued, the stocks went higher. So investors have learned that the contrarians are always wrong, that the bubble can last longer than anyone expects, that you can keep making money by staying long. This creates a positive feedback loop where past gains justify future purchases. There is FOMO, fear of missing out. Everyone else is making money. Your friends are making money. If you are not invested, you feel like a fool. You feel left out. You feel like you are losing. So you buy even though you know the valuation is crazy, because you cannot stand watching everyone else get rich while you sit on the sidelines. There is anchoring bias. People anchor to the peak prices. If a stock was $1,000 and falls to $800, people think it is cheap. They think it is a bargain. They do not evaluate whether $800 is justified by fundamentals. They just see that it is lower than it was, so it must be a good entry point. This causes people to buy all the way down during crashes. There is confirmation bias. People seek out information that confirms their existing beliefs and ignore information that contradicts them. If you own these AI stocks, you read the bullish articles, you follow the bullish analysts, you listen to the bullish podcasts, you ignore the warnings, you dismiss the bears, you convince yourself that you are right and everyone questioning you is wrong. There is the sunk cost fallacy. People have already put money into these stocks. If they sell now, they have to admit they were wrong. They have to lock in losses or give up paper gains. That is psychologically painful. So they hold, they rationalize. They tell themselves it will come back. They throw good money after bad. These psychological biases are incredibly powerful. They override rational analysis. They cause smart people to do dumb things. They are why bubbles get so extreme and crashes are so brutal. Because people cannot help themselves. They keep buying because it feels good, because everyone else is doing it, because they do not want to miss out. And then when it crashes, they cannot sell, because that would mean admitting they were wrong. I have watched this play out over and over, with technology stocks in 2000, with housing in 2007, with crypto in 2021. The pattern never changes. The psychology never changes. And the result never changes. People who buy bubbles lose money. Always. Every time. Without exception. Now let me talk about what the crash is actually going to look like when it comes. Because I want you to be prepared. I want you to recognize it. I want you to understand what is happening so you do not get caught in it. It will start with one of the catalysts I mentioned. A major AI failure. Margin compression. A write-down. Whatever the specific trigger, initially the market will shake it off. The stocks will drop 5 or 10% and then recover. People will say, see, no big deal. The AI story is intact. Buy the dip. But then more negative news will come out. Another data point showing slowing growth. Another competitor announcement. Another customer scaling back spending. The stocks will drop again. This time 15 or 20% from the peak. The volatility will increase. People will start to get nervous. The financial media will flip from bullish to questioning. Articles will appear asking if AI stocks are overvalued. Analysts will start downgrading. The narrative will begin to change from limitless growth to concerns about sustainability. Then one of the high-profile stocks will really blow up. Maybe it misses earnings badly. Maybe it guides down aggressively. Maybe it announces a major strategic change that spooks investors. Whatever it is, the stock will fall 30 or 40% in a day. And that will be the crack that breaks the dam. Suddenly, everyone will panic at once. The selling will cascade. Margin calls will trigger forced selling. Algorithms will amplify the move. The stocks will be in free fall. Down 5%, down 10%, down 20% in a single day. And the next day, it will continue. And the day after that, people will try to sell, but there will be no buyers. Bid-ask spreads will blow out. Liquidity will evaporate. The stocks will gap down at the open and keep falling. The financial media will go from questioning to full panic. Headlines about the AI bubble bursting, about trillions in losses, about a market crash. And retail investors will be frozen. They will not know what to do. Sell and lock in the loss? Hold and hope it recovers? Buy more at lower prices? They will be paralyzed. And while they are paralyzed, the stocks will keep falling, 30% down, 40%, 50%, and still falling. The whole thing will play out over 6 to 12 months. There will be brutal rallies, days where the stocks bounce 10 or 15%. People will think the bottom is in. They will buy, and then the selling will resume and the stocks will make new lows. This will happen 3 or 4 or 5 times. Each time, people will lose more money. Each time, the pain will intensify. By the end, the stocks will be down 70 to 80% from the peak. Trillions of dollars in market value will have been destroyed. Millions of investors will have lost enormous amounts of money, and everyone will ask, how did we not see this coming? The warning signs were so obvious in hindsight. But I am telling you right now, the warning signs are obvious right now. You do not need hindsight. You just need to look at the valuations. Look at the assumptions. Look at the history. It is all there. Clear as day. These stocks are going to crash. The only question is when. Let me now address what you should do if you own these stocks, because I know many people watching this do own them, maybe directly, maybe through index funds, maybe through retirement accounts. What should you do? First, you need to make an honest assessment of your situation. How much of your portfolio is in these 7 stocks or in AI-related stocks more broadly? If it is a small percentage, 5 or 10%, you can probably afford to hold and see what happens. The downside is manageable. But if it is a large percentage, 20 or 30 or 50%, you need to reduce your exposure now. The risk is too high. Second, you need to think about your time horizon. If you are young and have decades until retirement, you can afford to take more risk. Even if these stocks crash, you have time to recover. But if you are older and close to retirement, you cannot afford to lose 50 or 80% of your portfolio. You need to be more conservative. Third, you need to think about your emotional ability to handle volatility. If you own these stocks and they fall 50%, will you panic and sell at the bottom? Or will you be able to hold through the pain? Most people think they can handle volatility until it actually happens. Then they discover they cannot. If you are not sure you can hold through an 80% drawdown, you should reduce your position size now to a level you can handle. Fourth, consider tax implications. If you have large embedded gains, selling now means paying capital gains taxes. That is painful, but losing 80% of the value is more painful. Do not let the tax tail wag the investment dog. If the stocks are overvalued, sell, pay the taxes, move on. Fifth, if you do decide to hold, at least hedge. Buy put options to protect against a crash. Buy inverse ETFs. Short some index futures. Do something to protect yourself. Do not just sit there fully exposed hoping everything will be fine. My recommendation is simple. Sell these stocks. Take your profits if you have them. Take your losses if you do not. Get out. Move to cash or move to safer investments. Protect your capital, because when this bubble pops, capital preservation is going to matter more than anything else. Let me close by talking about what happens after the crash, because there will be an after. The world will not end. The stock market will not go to zero. Life will go on, and there will be opportunities. After the dot-com crash, many technology stocks fell 90% or more. But some of them recovered and went on to become enormous winners. Amazon fell from $106 to $6, a 94% decline. But if you had bought at $6 and held, you would have made over 200 times your money over the next 2 decades. Google went public in 2004, after the bubble had popped. It has been one of the best performing stocks of the past 20 years. Facebook, now Meta, went public in 2012. Also a huge winner. The point is that after bubbles pop, after the excess is wrung out of the system, great companies can be bought at reasonable prices, and those turn into great investments. The same thing will happen after the AI bubble pops. Some of the companies will disappear. Some will struggle for years, but some will emerge stronger. And if you can identify which ones, if you can buy them at reasonable valuations after the crash, you can make a lot of money. This is why I'm holding cash. This is why I'm preparing. Because after the crash, there will be opportunities to buy wonderful businesses at fair prices, to buy AI exposure without the bubble valuation, to position for the long-term value creation from AI without taking the near-term bubble risk. The AI revolution is real. It will create enormous value over decades. But you do not have to buy at the peak of the bubble to benefit from it. In fact, buying at the peak is the worst possible way to benefit from it. Better to wait, let the bubble pop, let the valuations reset, and then buy when things make sense. I have been through this twice before, .com and housing. I know how it ends. I know what the crash looks like. I know the opportunities that come after, and I am positioning myself accordingly. I hope you will too. You have been warned.